I want to go slowly and carefully over what we're going to talk about, so it might be very useful to you. We specialize in a very unique way of forecasting what the future of the markets are going to be. And I have to tell you that what I'm going to go into today is actually going to be teaching you the very basics behind one of our forecasting methodologies, which is called reflected wave. Reflected wave is a method that I actually teach here in Las Vegas at the Mirage Hotel coming up in May of this year, May 2nd and 3rd of 2015. And later, after we get through some of what I'm going to talk to you about today, we'll go into some detail about if you have any questions about attending that seminar. First thing I'd like to do just real briefly is tell you a little bit about myself. I began trading back in 1990, in May of 1990, and I've been trading every single day, or forecasting every single day since then, which is in May of this year will be my 25th year. So I certainly am not a newcomer, and I know many of you are. Some of you are perhaps newcomers, but many of you are not newcomers to the market. But what we titled this presentation about had to do with going beyond day trading. And before I tell you about why I don't want you to be depressed about going beyond day trading, some people feel as though, does that mean that day trading doesn't work? We want to show you how it all really lays out. And so before we get to that, though, I'd like to talk to you a little bit about one of our main methods, which is called reflected wave. Now, reflected wave is based upon a principle that, although it's not based in the markets originally, it's actually an Indian principle. It's the principle of karma. And you've all heard about karma. What goes around comes around. If you do something bad later happens to you. If you do something good, then good tends to happen to you. Whatever, there's many ways to interpret the Eastern version or vision of karma. But when I began in the markets and I began looking at them, I was immediately struck with the idea that there may be a form of karma in the markets. That is, that when something happens in the markets, it creates a kind of a debt, and that debt needs to be paid at some point, and the payment is going to occur in a unique way. So I want to give you I want to lay out for you the basic idea behind reflected wave so that you can understand, when I show you a little later what we're doing in the markets, you can get a better idea of why what we're doing actually is possible. So let's take this blank screen, and I hope everyone can see my screen here. I've got, of course, the S&P on it over here, but what I want to do is draw with my pencil a supposed move in the S&P. So we had a move, let's just abstract a move out that goes from a low, I'm just drawing a line underneath there, up to a high, and that is the move that we're going to discuss. Now, in reflected wave, our methodology, which has a karmic kind of ideology or philosophy behind it, what the basic idea is that this movement from here to here, no matter what time scale we're looking at, or no matter how much price movement this represents, but let's just assume this represents a daily chart perhaps, and this could be 50 points of S&P movement, let's just say. And in our work, when that movement occurs and a new movement begins on the downside, whatever that new movement's going to be, when this movement has completed, this movement has created a wave, a theoretical wave that is going to travel out from the beginning or the ending of the move, which is up here, and that wave, just as if you and I were standing in a pool and we had a board and we pushed some water with that board, that's what happens when the market moves from here to here. That's a push of this theoretical water, if you will. It sends the wave out, and here is that wave traveling out, and it travels at a specific speed that is relatable to the move originally itself. So let's say after a certain period of time, that wave finally comes across the end of the pool. Okay, here's the end of the pool. So if we were to number this, we could say, let me get rid of that. We could say this is number 1 right here. This is number 2 right here. We're talking about sort of events in the market. And this is number 3 over here. So what has happened is that the market made a move. Let me just put that 3 right about there. The market made a move from here to here, and that move sent out a theoretical wave, just like as if this move was you and I in the pool pushing water. It sent out a wave. That wave hit the edge of the pool, and by the way, the distance of this edge, the end of the pool, is relatable to the time frame. So if this was a daily chart, the edge of the pool is further away. If this was a 60-minute move, the edge of the pool is closer. So the longer the time frame, the further the edge of the pool is. Now, once the water or the wave hits the edge of the pool, or the side of the end of the pool, that sends the wave, the theoretical wave, back. So up until this point, the wave was moving in one direction, and now is reversing. And in the period of time that all of this movement from here, from number 2 to number 3 is happening, the market is making new moves in the market. And those new moves are, each of them are sending their own theoretical wave out as well. But to not confuse things, let's stick with the main wave that we're talking about, and it's karma. That means it sent out the wave, and at some point that wave is going to return. And lo and behold, as the market is moving and doing all the different things that it does, finally this wave is on its way back, and on its way back, when it finally gets to where the market is at this point, it actually intersects with the market. So from point 1 to 2, we began a theoretical wave. That wave traveled a certain distance. It hit the reflecting surface. The wave starts its trip back, and in all of that time, these subsequent movements are all happening. And then when that wave finally does come back and intersect the then current market, this is what the market does. It turns right where that intersection occurs. And that intersection occurs because this original move back from 1 to 2 is actually now the debt that was created by that movement is now being paid back, and the market now, right from this point here, reverses. And so this turn, this top, and this subsequent move are all relatable to this original move here. I hope you find that interesting. I can assure you, you probably have never seen or heard this explanation before for what's happening in the market. And it's not only happening on this one time frame, but it's happening on every time frame. This time frame alone, it's not only just happening on every time frame, but even on this time frame alone, each of these subsequent turns sends out a wave again of a certain size, and since it's a daily chart, it's going to go out to that same edge, and that is itself going to reflect back, and that may very well have to do with this bottom when the wave comes back and intersects with where price is at this point and causing this turn. So you can see that the market, in at least the way that we're looking at it, is continually sending out the reflected wave. The wave does get reflected, it comes back, and wherever price is when the reflected wave originally sent it back, wherever it is at that time, there's a very important event that takes place in the market right there, and it's a turning point. So I hope that isn't too confusing. I'll take the second one off because I don't want it to be too confusing, but just by breaking it down as we have here, I'm showing you the basic philosophy behind reflected wave. So this means that every market is sending out theoretical waves that at some point are going to be reflected back from the edge of the swimming pool, that time frame that the market is in, and when that theoretical wave returns, it's going to pay back the debt from the first market move that originated it in the first place. And you can see why we think of this as karma. We think of it as karma because it is literally this movement impacted time and space, and it sent out a wave, and that wave returned, and now it impacts time and space again. And that keeps the market rolling on and on and on. So it really does kind of go along with what goes around comes around. So there's that. Now I want to have you take a look at just ordinary market movement, and you can kind of imagine, perhaps, that there are waves going out and waves coming back and triggering all these different movements that you're seeing here. Now, for practical purposes, I'd like to show you a little bit more about what it really looks like to actually do reflected wave in the market. And I want to also tell you that this is the first time that I've really explained with any real depth how this methodology actually works. And again, we teach this methodology, and it will be taught on May 2nd and 3rd at the Mirage Hotel. Later, I want to go into some detail and give you the details about that. Now, I want to also mention that you can see that the S&P right now is rallying, and I can tell you that this rally is part of and parcel to a reflected wave that we forecast this morning. And I'm going to show you that in a little bit. But before we do that, let's take a little bit of time here, and let's take a look at what it looks like to actually trade with reflected wave so you can understand. Let's start with this S&P move on the left-hand side here. This chart goes back to January 14th, which was Wednesday of last week. And at this point, we had detected that the market would need to go down further to interact with the reflected wave, and that if the market closed below 1988, it would indicate a decline to 82 to 79. And in this particular case, it didn't quite close below 88. It closed at 88.25, but it was good enough for the market, and the market did indeed go down, and it went down to 1981.25, which is exactly where the reflected wave indicated, 82 to 79, where the market would be heading. Let me show you another indication of a move like this. This is coffee. Now, many of you probably don't trade in coffee. It's a very tricky market. It has a lot of unusual movement, but it's also a very profitable market if you can put it together. Back on Wednesday, January 7th, this is 2 weeks ago, we had forecast that coffee should begin a decline from roughly this area, 180, down to $168. Now that's a $4,000, if I'm not mistaken, per contract decline. And the market did take several days here to test and spike. They never did close above that high the day that we gave the forecast out, but they tested it several times, and then finally they began the move down. And today, this very day, they completed the 168 level and lower. Now, the market's gone down as low as 163.85 so far. You can see the low right here. That's another example of what happens when the wave gets intersected. Here on the right-hand side is the E-mini S&P, and Thursday of last week, January 15th, to all of our subscribers, we gave out the indication that the S&P after the 15th would want to advance from roughly 1980 up to 2027 to 2028, and would reach that price on Tuesday, January 20th. Today is Tuesday, January 20th, and this is a 2-hour chart, so you can see every bar here is 2 hours, and you can see that the market indeed climbed up from the 15th, and although it did have its pullbacks, it made a high today, Tuesday, January 20th, at $2,026.50. Just 2 ticks off of 2027 to 2028. The timing of these trades is based upon reflected wave in almost every instance, what I showed you earlier. Let me show you a few other examples. And by the way, while I'm giving these examples, I want to have you make a note or write down any questions you have in the text box, and I'll be very happy to answer them as we finish up here a little bit later, as best as I can. But I want to show you a few more examples of the methodology that I showed you a few moments ago so that you can see how many different variable ways it plays out in the market. Here's an example on Monday, January 12th of last week. We have a live messenger, which is a box. In fact, let me show it to you. This is what it looks like. And the live messenger purpose of that is to give you intraday trades that are based upon, in part, reflected wave. And so we mentioned that a daily close on Monday, January 12th, this was last week, above 2019 would advance to 2040, basically a 20-point move. This is a 15-minute chart showing you the last bar of the day, which was showing you that it's at 2022.50. And that 2022.50 is above 2019, and therefore the market the very next day, because we're saying it's going to happen tomorrow, should go up to 2040. And you can see the market did indeed go up to 2040. In fact, it made a high of 2051.75. But in terms of the forecasting, the move that we were forecasting, a 20-point move in the S&P, did occur, and it occurred right on the exact time that we said it would, which has to do with what I showed you earlier, with the karmic effect of that energy coming back to the market. Here's another shorter-term S&P trade. Don't even worry about that because it's not even fully explained, but I don't see the full explanation on here, but no worries on that. Let's go to the right-hand one here. This is Thursday, January 14th. Aggressive can short the S&P for a decline to at or near 1968. We were at 1982 at the time. So this is a decent-sized move, and you can see why we talk about the go beyond day trading. And I'll talk about that in a minute. But the market did indeed decline from 1982, and we got down to a low of 1970, which is just, we said, at or near 1968, and they made a low of 1970.25. From 82 to 70, obviously that's about a 12-point move in the S&P. Very decent trade if you wanted to take that. I'm going to show a couple more, then I want to talk a little bit more about how this can be put to work in your trading and some other ideas that I really want to present to you today. Notice over here on the left we have gold. Starting back on January 5th, we were putting out the indication to all of our subscribers that because of reflected wave and one other approach that we utilize, that gold could be bought upon any daily close above 1201 for an advance to 1245 to 1246. Now this is another $4,000 per contract move. Not $4,000 for the whole move, $4,000 for every contract you have. The whole move is $4,000, but it's per contract. So if you have 2 contracts, that's 8, 3, 4, and so on. You can see we closed that day above 1201. We closed at 1205.10. And that sent the market up immediately to 2038, our initial profit target, and then 2045, and then the market has subsequently gone substantially higher as well. But it was a great call for a big move in gold. And again, what I showed you earlier plays a big part in not only what has happened in gold, but now the fact that February, which is the following month, is now going to be the next on-time top for gold, because we can track that reflected wave, and we know when it will, so to speak, the theoretical wave will intersect with the gold market. And that means that February, next month, will be the next important monthly top in gold. So keep an eye on that, and we can talk when we come back here on another occasion. We'll talk more about that call. This is a 12-point move in the S&P just from a few days ago. This was a call for the dollar to come all the way back down and test down here before going higher, which they have done. A few others, and then let me get this chart straightened out a little bit, and you'll be able to see what the call was here. Actually, this one might be. Okay, yeah, that one. Don't worry about that because that one I've already shown you. And anyway, a couple more here. Here was a break of 2030 for a 10-point decline down to 2021. Here on the S&P on the 5-minute chart, another 10-point move. All of these are based upon the idea. They're not just using ordinary indicators to tell you that something is overbought or oversold. What this is telling you is that the market is about to interact with one of its own previous waves. It's actually going to have to interact with that at some point, depending on when that wave started and what time frame it belongs to, and so on. So we have worked out all of the time frames, if you will. The market could be viewed on any number of time frames, obviously not just the ordinary, 30, 15, 5-minute, and so on. It could be, you can view the market as one whole thing, and you could have 1,000 time frames. We've worked it out on all of the larger and more important time frames, and including the short-term time frames as well, so that we can put together reflected wave turning points and trade off of them. Now, let's talk a little bit about day trading. Oh, by the way, here's an $8,000 per contract move in crude oil. Now, many of you don't know us, and so I'm not going to ask you to believe me, but I'm going to tell you the fact that back in July of 2014, we're on live radio programs every day, and we did forecast utilizing both reflected wave and one other methodology that we use. We had forecast that crude oil was going to have a biblical decline, and all of this is recorded at the radio station. I'm going to give that radio station out later. You can go over there and check it out. That there was going to be a biblical move in crude oil. Crude oil was then trading at about $98, and that biblical move was going to smash crude oil to a level that we couldn't even really forecast. We did forecast levels, but it was going to go way beyond those levels. So far, crude has moved down over $50,000 per contract since that point, or right around $50,000 per contract. But just recently, when the market was trading at $56 back on December 17th, we let our subscribers know this is not a bottom, and that in fact the market needs to and will go down another $8,000 per contract from here, which would take you down to $48. And of course, we're even below $48 right now. We're down at $46. But this was the move. This is that force hitting the market again that is forecastable in advance, utilizing in part the methodology that I showed you earlier. Just a few days ago, when the bond market was at January 12th, was at 148.05, we forecast the market would continue up from here, break out above this high, and run to 150.25. And lo and behold, that's exactly what the market did. So what's very interesting is that even though this would be considered resistance, this old high, and it would be difficult for someone to forecast that that would be broken, it's not difficult to forecast that that's going to be broken completely in advance when you understand the wave and its implications. Now, this has nothing to do with Elliott wave, and we've had many discussions in our own group about the difference between reflected wave and Elliott wave. And you can see by the description that I gave you earlier, showing you reflected wave, that there really is there's nothing there's no wave counting, so to speak, in reflected wave. It's a very, very different approach. But the name of our seminar or webinar today is Go Beyond Day Trading. Now, we do day trade, but we don't day trade for very small amounts of money, nor do our clients. As an example, it's very common for people to day trade for 8 or 10 ticks, something like that. And what I'd like you to consider, this is not being told to you to depress you or to take you away from whatever is working, but I at least want to give you what our outlook is and let you at least think on it. You don't have to take it as the absolute truth. But one of the main problems with day trading, whether you're day trading for large or small amounts of money, but particularly for small amounts of money, is that you have to trade quite often in order to make that money. If you're trying to make a certain amount of money a day, or you're trying to take whatever trades are available, you're going to be trading a number of times to make $100, or each trade is going to be $100. If you're looking for $500, you have to trade 5 times, something like that. If you look at the trades that we're putting out here utilizing reflected wave and our roadmap principle, which is the other methodology, all of these trades that are intraday trades for the S&P, just as an example, these almost all are intraday trades for much, much larger points movements, 20 points, 18 points, 10 points, and so on. So that you're only going to be trading one time. You're not going to be trading 7 or 8 times to try to make $700 or $800. You're going to be trading a single time to make all of the gains that are available through that reflected wave, that trading setup. So that's what's so interesting about this, is that when you day trade for very small amounts of money, you're working a lot harder to make a lot less. The harder is that you have to trade more often, and you're making less per trade. What we're doing and what we're asking you to consider is that in day trading, if you can put it together to make larger gains, it makes tremendously easier to hold on to the gains that you've made, and you're not playing around with very small amounts of money. One of the other issues is that there is something called the reversion to the mean. And that sounds like a very complicated thing, but it basically means that, as an example, if I were to take 10 flips of a penny and flip a coin 10 times, it's quite possible, but unlikely, but it is quite possible that I could get 10 heads in a row. Now, I'm not suggesting that your trading and my trading is like flipping coins, but what I am suggesting is that although we could get 10 in a row, what tends to happen in ordinary life is that the more incidences there are of the same thing, that it tends to start to balance out. That's why they call it the reversion to the mean. So that if I flipped a coin 10 times, I might get 8 heads and 2 tails. But if I were to bump that up to 100 times, it would be much, much more likely that I would be much closer to 50 heads and 50 tails. Try it out sometime. And then if I bumped it up to 1,000 times, that's more incidents of the same event, it gets not only extremely likely that we're going to be very close to 50-50, maybe 60-40 or whatever it is, if not 50-50. It's not only that, but it's going to be more difficult to pull away from the reversion to the mean. In other words, once you're at that 50-50 point, it's hard to get out of that gravity center where it's 50-50. And what are we referring to? We're referring to the number of decisions that you and I have to make trading in the markets. The number of decisions is extremely important, almost like a carnival game where it seems like, hey, I can just make a bunch of decisions and everything will be fine and I'll just keep making decisions, but you don't realize that those decisions actually have a lifespan to them. They're really connected together, just like the market's connected together from yesterday and the day before, and the more decisions you make, the more difficult it gets to stay away from being influenced by the reversion to the mean. This is why day trading is difficult when you're day trading for very small amounts of money. So if I were to go into our website, this is what it would look like on the back end, meaning that once you're in the site, you can see there's a number of different trades here. These are all these different markets. I can select S&P, and I'm selecting the S&P because we do day trade this. And you can go through, there's 300 plus trades here. But if you look at the dates, you'll see that we rarely trade more than once on any single day. There's most days it's a single trade in the S&P. Like if I click View Report, this is our report right here about the Thursday, January 15th trade, which, let me click that and blow it up, which is the one that I showed you earlier, which was really about a 40-point move in the S&P. Now, that one did require an overnight position, so I just want to point out that that's not a day trade. But if you're willing to hold overnight positions, you'll find that this works in your favor as well. Here's one that was a day trade. This was the move from 1082 down to 1068 or 1070. So what we're suggesting to you is that unbeknownst to most market participants, the number of decisions you make has a very powerful impact on your overall trading. Even though you may not understand how that impacts you, it does impact you. There's no question about it. The reversion to the mean is a well-accepted scientific principle that occurs in all kinds of things, including your day trading, including my day trading. So we make a very concerted effort. I'm just flipping through some recent charts here. We make a very concerted effort to not trade a lot and instead make single trades with much larger returns on that single trade. January 9th here, this is an 8-point decline. Now, for a day trader to make 8 points, maybe a day trader is trading for 2 points. Well, he would have to trade 4 times, and that means 4 times correctly in order to make what this trade makes in a single movement. That's 400% worse than this. That's a lot of percentages to be working against. And that's one of the reasons that we say what we say about day trading, which is that you have to understand that you are under the reversion to the mean principle. Again, not to depress you and not to make you concerned. Here is a recent 12-point move in the S&P. Already the market had been down. A test of 2017 is expected from here, and we were at 2029. The market declined to 2017.75. Now again, all of this is utilizing our reflected wave principle and other methods to forecast what the most likely thing the market's going to do. So what's the takeaway for you today in what I've told you? Well, number one, for you to seriously consider that part of the problem of day trading for small amounts of money is that you're unknowingly influenced by a scientifically established principle known as the reversion to the mean, and that your decisions themselves, irrespective as to whether or not they're decisions to go long or short, or even if they're decisions to trade, or whether they're decisions about who to marry, or they're decisions about when to mow your lawn, if you make lots of those decisions, you will be impacted by the reversion to the mean, and the right/wrong of your decisions, how many times you're right and how many times you're wrong, is going to be impacted by the reversion to the mean. You could counter me and say, but wait a minute, I have a methodology, and that methodology is going to counter that force, that reversion to the mean force. What about that? And I would say to you, I agree that it counters that, but the reversion to the mean, why would you want to fight a natural principle in your trading? In other words, the natural principle is if you make lots of decisions, they're going to ultimately revert to about 50-50 right, 50-50 wrong over time. Why would you want to fight that force in your trading? Why would you want to chew up some of the edge that you have in your trading in order to fight a natural force such as the reversion to the mean? You don't want to be doing that. If I may speak for you, you don't want to be doing that, and that's why we don't. What we're doing is we're consciously not making lots of decisions. We may only make 3 or 4 decisions a week in the S&P, but each one of those, some of them will have 15 and 20-point gains, 8 and 10. You've seen a dozen of them here. That's what we're going for, and therefore, if to whatever degree we're influenced by the reversion to the mean, we've reduced it dramatically by making less decisions for more money, more gains per decision. And I want you to think today, having heard this possibly and most likely for your first time, that the number of decisions you make plays an enormous part, unknown up till now, in your overall outcome. And that if you could make 10 points in a trade, in a single trade, that would be vastly superior to making 10 one-point trades or 5 2-point trades and having to deal with the back and forth of some of those decisions being right, some of those decisions being wrong, and so on. So it's a big deal, and I can tell you that we've proven it to ourselves, and I hope you can understand that what we're doing here is quite scientific in the sense that we know that there are principles that are at work that influence anything that moves through time and space, and that includes decisions and the market itself. So I hope that's interesting. Now, people have asked us in the past whether or not we trade ourselves, if we just give these trades out, and we do trade ourselves, and we also show our statements. And before we're through here today, and I know we only have another 15 minutes or so, I would like to show you our most recent trading statement, so that if you do decide to take a look at some of the work that we're doing, and I've presented some I hope, some very useful ideas for you to at least consider today. Number one, that the markets have a karmic kind of quality to them, that something that happened quite a while back actually will have an influence on the future of the market, even though the event itself, that price move itself, ended. It's over. But it being over doesn't mean that the ripple effect, the karmic effect of that move has actually stopped being in motion, and it has not. And I would suggest to you that all those little ripples back and forth in the market that you see on the price chart are themselves the evidence that these reflected waves are coming back and impacting the market. Now, no illustration I can give you will hold through to all times and all places. There are no perfect illustrations of anything, because life is too big for a single illustration to contain every possible thing that happens. But I think by taking a look at the trades that we've taken and the forecasts that we make for these various markets, you'll be able to see for yourself that much of what we're doing is forecastable precisely because the markets do send out these waves and they do return. We do the same work in stocks as well. This is Goldman Sachs. This is back in December, looking for Goldman to decline from 196 down to 191 or so. A decent move.
Hey, David, I don't mean to interrupt.
Please.
Sorry, but you do have about 7 minutes left. It was a 45-minute slot. We got about.
My mistake.
Yeah, sorry.
Yeah, that's good. I only have to make one decision then. I don't have to have the reversion to the mean decisions play impacting. Thank you so much. Just trying to make humor here. Anyway, so let me wrap it up here a little bit. I did want to tell you a couple quick things if we only have 7 minutes left. The purpose for us coming here today was to give you some new ideas to think about. I want to encourage everybody to continue, of course, trading, and we think the markets, the fact that they exist, is the most remarkable thing of all. You can step up if you have an understanding of what's going on. You can actually take advantage of it. You've heard me speak about the term having an edge in the market. Our products are called Williams Edge. They're named after me because I developed certain edges in the market that we have that you're able to see us trading here. And you're welcome to take a look and review for a couple of weeks, all of you, for free, no charge, no credit card, no nothing. If you'd like to, you can go to pagetrader.com, pagetrader.com, or you can write our phone number down, 888-231-4702, and watch these forecasts be given out in real time and watch the subsequent movement of the market for yourself and see if that is not proof of what I'm telling you, number one, and also perhaps very useful in your own trading to align it with what you may already think is happening in the markets. One other thing, we do get questions a lot about whether we trade in the markets. I just put up a trading statement which has been reviewed in full by a licensed broker. His name is Bert Schlichter from Daniels Trading. Bert Schlichter, I want to give his phone number out, 866-928-3310, 866-928-3310. I'm not giving you that number to sign up and do something with Bert, but Bert is a broker that we know, and he has fully reviewed this statement. What I'm showing you here is not hypothetical. It's an actual statement at Schwab with real money in it, and it goes back to April 1st of 2011 when we first began giving our seminars out where we teach reflected wave. You can see we're selling puts and calls against individual stocks. Now, some of you may or may not know about doing this. It's not super advanced, but it is more advanced than just simply the ordinary market stuff. But either way, and on the right-hand side, these are profits or losses in this statement. I can distinctly remember when we started this, when we first made our first, 10,000 or whatever. I'm just going to flow through. There's probably 800 trades in that period of time. I'm just going to go through all these stocks. But each one of these has to do with a forecast for a market top or bottom, utilizing reflected wave. These are the profits or losses that we've taken. I remember when we reached $10 and $20 and $30,000 in gain. I remember when we got to 50,000 and so on. Let me cut to the chase and show you where we are as of January of this year. These are all the losses. For this red here, these are all the losses accumulated in one spot. So we just put them all in one spot. And this is where our account is as of January 1st. $636,288.87 in real money. That is the actual profit that we've made in 3.5 years trading in this account. This account, again, has been fully reviewed by a licensed broker, Bert Schlichter from Daniels Trading, 866-928-3310. We're showing this to you not to say that you will make $636,000, but it's to show you that we actually are utilizing our own methodologies in the market, and we believe very strongly that although there's many, many different valid and wonderful ways to trade in the market, we have found a very specific kind of edge that could be very useful to people who maybe not necessarily the newcomer so much, but maybe somebody a little bit further along that this kind of work could really make a big difference in your trading. So having said that, I know we're very short on time here. Let's just take a quick overview, a recap here. Markets are not random. If they were random, we would not be able to do what we're able to do. So all books and theses about markets being random are nonsense, because none of what we're doing with directly forecasting where markets are going to go would be possible in a completely random environment. I think most of you know that. Number one. Number two, the non-random nature of markets has to do, in part at least, with the fact that there's a karmic quality, that each movement creates a debt that later has to be paid off, and that payoff happens in a kind of a unique way, which I described to you with our chart earlier. Number three, that in day trading, if you're making too many decisions, you are impacting your own performance in a negative way without recognizing it. It's very difficult to see by yourself that you are reverting to the mean over time, and that you want to use a methodology that does not tend to produce reversion to the mean. That means you have to make less decisions with much larger gains per decision, and then that reversion to the mean will not affect you. And you can watch us in our trial, in the trial if you'd like to take one, do that over a 2-week period, and you can go back through all of our history, all wins and losses are shown, and so on, to check it out for yourself, the benefits of not invoking the reversion to the mean, as many, many people do in the markets. So I hope this has been useful and interesting information. It's probably a little different, but I want to thank all of you for your attention today, and if we have any few minutes left, I'll take any questions you may have. I'll answer them as quickly as I can here, if there are any. I'm not sure if...
You've got about 1 minute left, yeah.
Okay, I'll take one question then. Give me the one, if there is one. Do you want me to go into the questions myself here on my end? I can open them up. Are you teaching this method or selling these forecasts? That's one of the questions. We teach the method. I'm not related to Larry Williams. We do teach the method coming up here on May 2nd and 3rd, 2015. You can call in and get more information about it. You can also call us and ask us your questions. And I apologize. I didn't realize. I thought we had a few minutes more. It's no problem. Our phone number again, 888-231-4702. And you can get all your questions answered about subscription rates and so on. I'd like to thank all of you for spending some time and listening to us today, and I'd like to thank the good folks here at Smart Investing for having us here today. And I wish all of you the best in your trading, and I hope to see you next time that we come here to talk more about these wonderful markets and what can be done with them.